Hey, this is Dr. Tom again, and this is our third video in internal controls. And in this one, we're going to talk about banking. And maybe some of you work in a bank, and so you might really be familiar with some of this stuff, and other people don't know much about it at all. So if you know anything about banking, or you don't know, let's put it that way, here's some of the stuff that they talk about in banks. Deposits, so you go into the bank and you're supposed to make a ticket out that says this is how much I'm depositing. And the same thing with withdrawals, signature card, who can sign on your bank account? Is it your spouse? Is it your mom and dad? Or, you know, who is it that has signature authority? It's very important a lot of times to know who's on your bank accounts. Now, you could have, this is a whole different topic, but, you know, if I open a bank account and I don't necessarily want you to be able to write checks on my account, but I want you on my account as a beneficiary in case something happens to me, you know, then I want you to be able to get to the money without having to go through legal things to get to it. So that's a different thing. Bank account, checks, of course, and checks nowadays, a lot of it's electronic. That's what we call electronic funds transfer. But companies still issue checks. Maybe you've got a check in the mail from somebody you overpaid, or you had some kind of credit and they issued it back. Even credit cards, you know, sometimes you'll have a credit. Somebody issues you a refund on your credit card and you get a check in the mail. So let's talk about this. So deposit ticket, you know, this should be simple. Checks, the check, this might be the kind of check you, like I was just talking about, what it would look like, where they have the check up at the top, but they have some things down at the bottom that really explains it. We're not going to go through all that. What we really want to get to, first of all, also your bank statement. You get a statement at the end of the month. Now, most of us in the modern world of electronics and debit cards and all these things, nobody ever looks at this stuff anymore. But I can tell you, there was a day when your grandma wrote checks for everything that she bought, and at the end of the day, she would get it out, and she would get her bank statement in the mail, and she would go through it and mark it off. And when we went to the world of electronics and debit cards and things of this nature, we kind of got away from that. And so the only time that we know that there's something wrong with our bank account is when we go to use our card in the bank and they deny it, right? They say, oh, it's not going through. And you go, well, I know I got money in there. And then it doesn't work, right? And so and then what happens is you check your bank account and you see like, oh no, that deposit you were supposed to be thinking was going to come in, didn't come in, or didn't get posted. And so you didn't have the money. And not only did you have a bounce check, so to speak, or you know, it went over your overdraft limit, now you got a charge on there. And so not only did you not have money in the bank account, but now you've got a charge because a check came back or something, right? So this is the only time we do it now, but you'll see here, this is a picture of what it looks like. You can go on your bank website, pull up the bank statement. And again, in the olden days, not that long ago, grandma would get her checkbook and she would go through here. Okay, there's that check and there it is on the bank statement, and mark them off. And this is what we really do in accounting, only of course we do it a lot quicker now because we have electronic methods. And so this is called bank account reconciliation. And like I keep saying, you know, your mom and dad or your grandma, they used to do this every single month. And they would do their own bank account reconciliation. And nowadays we don't even think about it until something goes wrong. And so I'm going to get to here, and we're going to see what we've got here. Here's the bank account reconciliation. So remember, we have a company, we have our financial accounting system, and there's the bank that holds our money, and it has its system. And even though in modern world, if you have QuickBooks or one of these software systems, they connect to each other, they are still, the bank system is the bank system. Okay, your system is your system, the company's system is this company's system, the bank is their system. Right? So you have the cash balance is what we're trying to do. We're trying to, bank account reconciliation is balancing what we say we have in cash with what they say we have in cash. And it's almost never the same, right? And these are the things that could cause it. This is what this little slide is about. That's why I'm staying here for a moment. So the bank says this is how much cash you have in the bank, which, by the way, is really how much you have in the bank. You have an accounting software system that says you have this much cash in the bank, or you should have, right? So what's wrong here? So what happens is, think about, and the blue is the bank side. So the bank says you only have this much, and it says plus deposits in transit, because these are the ones that you thought got put into the bank and they didn't get put in. So maybe, like I just explained, in our own world where we're expecting a check to come in, our paycheck or whatever it is, and it doesn't clear. It didn't come in on the day we thought it was going to come in. In the world of business, a lot of times we have people that are out in the field. We call them drop boxes. So maybe you're a person that's working for a company that has multiple locations, and it could be a small store. It could be a service type thing where people are out in the field collecting money. And at the end of the day, they're supposed to put the money in the bank, and they call it a drop box. I'm going to bring this money over and I'm going to put it in the drop box. And I've seen this. I can't even tell you. This is very, very common. You have a department, and I'm going to use this. What was one of my places that this always happened was we had parks department, and we had the parks where we had the golf course, right? And people come in and they go golfing and they pay for their golfing, and sometimes they'll give you a check, and again, check is cash. And they're going to give cash, or they're going to give checks or whatever. And then what happens is, at the end of the day, when the person closes down, maybe it's after hours, right? Maybe it's open late, but the bank's closed. The bank's done. But I've got this cash now that we've got collected for this day, cash and checks. And we're on our way home, and we're supposed to put it in the drop box so that tomorrow morning the bank gets that money and can start doing their side. But what happens is, up here, cash balances on my books say, I pushed a button on my register before I left, that I closed the accounts, I posted things to the ledger, what we learned in the earlier chapters, post it to the ledger when I close my books out for the day, and I go home, and I've got this little, and I wished I had one here to show you. I probably do if I could look far enough. But the little, the little pouch with a zipper on it. Some of them have the zipper with a lock on it. That's got to have a key to open it. But we've got this money that belongs to the company, and I'm going home, and I'm supposed to drop it off at the bank in the drop box, the little thing you open and you slide it in there. And then the bank does it first thing in the morning. And what happens is, oh man, I've been working all day. It's really late. I'm tired. And I get home and I get in bed. I'm really exhausted. I'm sleeping, and then I'm just dozing off to sleep. And I think, oh my gosh, I forgot to stop at the bank, right? And so maybe now you're not even going to get there till the next day, or the third day, or the fourth day, because, I'm off tomorrow and I'm not going on my day off because, I'm going to stay in my pajamas all day. But whatever it is, the deposits in transit, your system over here says, we got this cash in the bank because you closed it out and pushed post to the ledger. And the bank says, no, we don't have that money. It's either in the back seat of your car, or it got put in late after we closed, whatever the case is, right? Now, most of the time, if it's like I said, it's just going to come in the next morning. Even if I put it in the drop box after hours, we're going to do it the next morning. But what if it's the last day of the month? What if this is the 31st of the month, and you put it in late after they're closed? Then it's going to get posted the bank is going to post it on the 1st of the following month, but on my books, it was posted on the 31st. So that's deposits in transit. Now, here is outstanding checks. These are checks that didn't get paid, right? So now again, so this says plus, right? Plus and minus. So minus is from the bank account. You say, your system says, well, we issued a check to pay for this service or these goods, and maybe you issued a check instead of doing electronic funds transfer, something of this nature. And the person got the check and they didn't cash the check, right? You've given the check to the person you're supposed to pay, and they haven't cashed it. They haven't taken it to their bank, right, to cash it. So this time period. So that's outstanding checks. So what the bank is saying, let's say it's $100. You paid somebody $100 for something that you owed them for, and they didn't cash the check. So what that means is the bank is saying, we still got the $100. So their bank account, in the bank, it says we got $100 more than what you're saying we got. So that's different from the deposit. So deposit says, your system says we got the money, but the bank says we didn't get the money. In the outstanding checks, you're saying we paid somebody $100, and here they're saying we still have the $100. It's not gone. Now, it says here, and you'll notice both of them say errors, because the banks do make errors, right? And people make errors in the software system. So it could just be an error. So these are the things that could go wrong at the bank. Now let's look over here on this side. Bank accounts, now in our books. So one of the things that we have is maybe there's interest that was charged. We didn't do those. Remember, we looked about collections and interest. So this could be things like we talked about when we were talking about our adjusting entries. Maybe adjusting entry didn't get done, right? We collected interest. Somebody owed us interest, and it automatically posted to the system that says, on the 5th of the month, if you haven't paid your bill, it's going to be more money. And you didn't get that. That was something that was off, okay? Bank fees and non-NSF, non-sufficient funds. That's the one that we catch, right? Remember I was talking about, oh my gosh, the only time we ever know something's wrong is when I go to buy something and they say, oh, you don't have any money in your account. And then what happens is I got a non-sufficient fund fee, a bank fee, or maybe even if this is be like, so I got a $35 fee because I tried a check went through and then it came back, right? So these are things that are in my system, or they're not in my system, I should say. They're not in my system that I've got to put that account for, because the bank says we charged you $35 because you had a check return, right? Or $50 or whatever it is. We charged you that, and so your bank account is less. It says we charged you a non-sufficient fund check, or the bank fee. Maybe there's a $5 or $10 a month charge just to have the bank account, and many banks charge you a monthly, especially in business banking. Now there are banks out there that don't charge you a monthly fee. If you're a small business, always find one that doesn't charge you a fee. But big companies use the Wells Fargos and those. They typically are going to charge you for a business bank account so much a month. And if you get really big, where there's lots and lots of money and lots of transactions, it could be a lot of money. That's another story in itself. Where where I worked, we had the government. At one time, we had over $200 million in the bank, and the bank was saying, hey, we're going to start charging you a fee to hold your money. And people that don't understand banking, the bosses would say, who don't understand, I have to watch what I say, they don't understand banking, let's just put it that way. And they said, well, let's just get another bank. Why on earth would we have to pay a fee to keep our money in the bank? And the truth is banks are in business to loan money, not to hold money. They don't want your money. They want money that they can loan out. And so during the recession and different times when there's no way to loan out $200 million, they don't want that money. They want money they can loan out. Now, if they can loan out $200 million, they're happy to take your money and pay you, a 0.5% on that, or 1%, and loan it out at 5 or 10% or more. But most banks, unless they're really big banks, they're a normal regional or smaller bank or credit union, they don't know what to do with $200 million. They can't loan out that. It's people buying cars and houses maybe. So you're not going to be able to get rid of it. So they'll charge a fee. Our fee was pretty high, hundreds of thousands of dollars to hold $200 million. Okay, so now banks, bank fees. So what that means is the bank's charging you a fee and saying, we've deducted out of your bank account, maybe it's only $5, because a smaller bank, a smaller business bank fee might be $5 a month. And they've deducted it from what they say that you're supposed to have, and you didn't put that in, right? So you have to do these adjustments, adjusting in your financial records to make it equal the bank. So remember now, I can't call up the bank, say it's the first of the month, and I say, hey bank, I got your money in the back seat of my car. Could you please adjust your, and my financial records say that we had deposited, but it's here, I brought it in, and it didn't get posted till the 1st, but it was really supposed to be the 31st. Could you please change it from the 1st to the 31st because you got the money? And the bank says, no, we're not going to adjust our records, because every time somebody calls up and says, well, you didn't post it on time, it got posted on the wrong date, or we put it in late after closing, or whatever it was, we're not adjusting our records, ever. The bank will not. Now, if there's a error, that's going to be a different thing, because it's going to be adjusted. Sometimes, if it's an error, they will adjust it during the period. But once that period is closed, and typically on banking, their cash system, they're operating on a cash system as opposed to an accounting system, they will not adjust it. They will make they won't adjust it during that period. They'll adjust it in the following period, because they're always balancing how much cash they have for all of the customers, not just you. So if there's an error and it's just your account, they're not going to be adjusting their overall picture. They're going to say, this is how much cash we've got at the end of the month, and we're not changing it, right? If we made an error, we'll do an adjustment, but it's going to be during the next month. So most of your accounting books are going to go through now the steps for this bank account reconciliation. I'm not going to do that here. I've talked quite a bit about it and discussed it. Now, of course, now your book is going to go through the transactions to account for all of these things that we just talked about here. Remember, you're adjusting your accounting records. The bank is not adjusting anything. They're a separate entity. They're keeping their records and you're keeping yours. And so any of these things that are wrong, you're going to go through these steps. Steps 1 through 4, steps 5 through 8. And here's the adjusting entries. And you'll see here that in all of these entries includes cash. So debit cash goes up, credit cash goes down. So you're going to see, are we short on cash or do we have too much cash, right? So here's non-sufficient churn, here's your check, here's interest, collection of notes, a lot of different things that we discussed. And so bank account reconciliation, very important, because you want your records to be accurate on cash, and you should balance this every single month. And we had a team of people that was their job, that did this, that they went through, and a lot of things happen, like we talked about with other things in internal control, where people forge the checks and things like that. So that's the end of this video on internal controls, bank account reconciliation. I hope you got something out of it, and I will see you in the next video.